Historically, life insurance in India has been sold as insurance cum investment option that offers dual benefit of insurance as well as return on maturity. It basically means that if you have opted for insurance cum investment plan and if nothing happens during that insurance period, you would still get a fixed return on maturity. That's a win-win situation, isn't it? On top of that, one of the biggest selling points by insurance companies is tax saving. The returns from insurance products are tax-free. That again attracted a lot of investors to invest in those insurance cum investment plans to save taxes. But here, there are two big catches. First, the return from insurance cum investment plans are on lower side. Majority of people don't realize this because they don't know how to calculate the return from their insurance plan. So when you opt for insurance cum investment plan, you neither get a good life cover nor get a good return on investment. And that is the reason I always say that you should never mix insurance and investment. Second, in the recent budget of 2023, Finance Minister has made a big announcement on insurance policies. Starting 1st April 23, if you invest in insurance cum investment plan other than ULIPs, and if your total premium for the year is more than 5 lakh rupee, then you will have to pay income tax on returns from your insurance plan. Like I mentioned before, one of the biggest selling point of insurance companies was tax saving. So that would make the endowment plans unattractive that packages insurance and investment. Of course, majority of people invest below 5 lakh a year. Having said this, there is no impact on term plan. And we have already discussed in the past why you should opt for a term plan, which is the purest form of life insurance. The biggest reason to opt for a term plan is you get a very high life cover at a very nominal premium. Since our life is uncertain, we want to ensure that our family gets a financial cover in case of an unexpected event, so that they can live a dignified life. Hence, term plan is a must for every individual. That leads us to one important question, which is the best term plan for 2023. So in this video, we'll look at a very interesting category of term plan, which is also known as zero cost term plan. I'm sure majority of you would not be aware of this zero cost term plan. So in this video, we'll cover what is zero cost term plan, how is it different from regular term plan, and how you can opt for zero cost term plan. Alright, let's get started. If you look at the term plan category within life insurance, there are mainly two types of term plan available in the market. First category is your plain vanilla term plan, where if the person dies during the term plan duration, his or her family would get a fixed amount of money. And if the person survives that insurance period, he or she would not get anything on maturity. Now the intent of this plan was to give your family a good life cover at a very nominal premium. However, many people would hesitate to take a plain vanilla term plan because they think that if they survive the insurance period, they won't get anything on maturity. And that's where the insurance companies offer second type of term plan, also known as return of premium. In this term plan, you will get back the entire insurance premium minus GST in case you survive till the end of policy term. So you would get dual benefit, where in case of death, your family will get the sum assured, and in case of survival, you would get your premium back. The only catch is that return of premium, that is ROP term plan, have almost double the annual premium as compared to your plain vanilla regular term plan. So on one side, while regular term plan would not pay any amount on survival, the return of premium plans would cost almost twice that of regular term plan. And that's where insurance companies have come up with a third category of term plan, also known as zero cost term plan. This zero cost term plan offers both the benefits of low cost premium similar to your regular term plan, and it has a special exit feature where you can exit at a specific life stage and get all your premium back whenever you want during the time period provided by the insurance company. But of course, the insurance company would deduct the GST part. So with zero cost term plan, you would get the flexibility of getting your premium back in case of survival that would have costed you twice with return of premium plan. So think this way. Let's say you opted for a zero cost term plan at the age of 30 and the insurance period is still 65 years. Now let's say at the age of 55, you have made enough money so that your family can live a comfortable life in case of your death. Then you don't really need the term plan anymore, isn't it? So you can choose to discontinue your term plan premium. Now in case of regular term plan, if you discontinue to pay the premium, you won't get anything on maturity. If you opt for return of premium, you will have to continue paying the annual premium till the age of 65. Then only you will get the premium back on completion of policy period. You can't exit in between. And mind you, you will have to pay almost twice the annual premium as compared to the regular term plan. However, with zero cost term plan, you have the option to exit at the age of 55 and get your entire premium back, or continue with the plan till 65 years of age. Here there is one catch. Every zero cost term plan will have a minimum duration that you need to pay the premium before opting for the withdrawal. So it is not like that you opted for a zero cost term plan today and after 2 years you discontinue the plan and get the premiums back. But when we opt for a term plan, we always select a long policy duration. So this zero cost term plan is a great option to consider in 2023. Having said this, you should check the premium difference between your regular term plan versus zero cost term plan and accordingly take a call. As I said before, the specific features like your annual premium, minimum withdrawal age, coverage amount, etc. would vary from insurance to insurance. And that's where you can consider scheduling a free 30-minute call with Ditto team that would help you opt for the best term plan as per your requirement. I have personally taken their services and extremely satisfied. Now you can even reach out to them over WhatsApp. The best part with Ditto team is, unlike other life insurance companies, they don't spam you with unnecessary calls and SMS and emails. So they are genuinely trying to solve a big problem of insurance mis-selling in India. It is also among the top 25 Indian startups on LinkedIn 2022 list. In fact, they also have a section where you can understand the important parameters that you should check before shortlisting a health and a term plan. If you want to explore Ditto platform, I have provided the link in the description box. Now before you opt for zero cost term plan, there are some important points that you should keep in mind. So let us look at those key points before shortlisting a zero cost term plan. So first, while opting for a term plan, you will come across a few riders that are add-ons to your base term plan to make it more comprehensive and suitable for your needs. So there are 4 key riders that you should be aware of. First is life stage benefit. When you finalize the term plan cover, you can't change it in the future. But in future, you might realize that you need a higher cover. For example, a term plan of 1 crore rupees today might not be enough in the next 10 years. So with life stage rider, the insurer will offer you the option to increase your cover by a certain amount during the major life events. For instance, when you get married and you have kids. Then second rider is waiver of premiums. If something happens to you and you become seriously injured or physically impaired and you end up losing your job, then your family suddenly loses their source of income. Now, how are you supposed to pay insurance premium in such a condition? Well, you opt for this rider, it will allow you to keep the policy and not worry about premiums if you get disabled. Then third rider is critical illness rider. These days, more and more people are getting diagnosed with critical illnesses like cancer or chronic lung disease. So in such situation, you are at risk of losing your job. However, if you opt for critical illness rider, the insurer will pay a certain amount to help you tide over the crisis. The amount could be your 10 lakh, 50 lakh, depending upon the amount you opt for. But this amount would be deducted from your sum assured. Then fourth rider is accidental death benefit. Accidental deaths are very common in India due to poor road condition and reckless driving. So if you select accidental death benefit rider, then you can get an additional coverage on top of the term cover. So in case of death due to accident, your family members would get some extra money and some extra financial protection. Now there are 2 major parameters that you should check while opting for a term plan. First is claim settlement ratio. It basically means what percentage of claims were settled by the life insurance company. For example, a claim settlement ratio of 98% means that out of 100 claims, insurance company has settled 98 claims. Needless to say, higher the claim settlement ratio, better it is. Then second parameter is parentage of insurance companies. Term plan is something that you take once in your life, and that is a long-term relationship with your insurer company, as long as 30-40 years. Hence, you want to associate with a company that you can trust, a company that would exist even 50 years from today. So don't just look at low premium to shortlist a term plan. Yes, you might have to pay a little higher premium with top companies, but it will give you a peace of mind, and that is more important than saving some money on annual premium. Now you might also have some common questions with term plan. So I want to cover 3 important questions here. First is, how much cover is enough for a term plan? So first of all, the term plan cover would vary from family to family. To answer this question, you need to ask yourself, what is your monthly expense? So let's say your monthly expense is 50,000 rupee. In that case, ideally you want to make sure that your term plan should have a cover that is good enough to take care of your 50,000 a month expenses. For example, let's say you take a term plan of 1 crore rupee. Now in case of an unfortunate event, 1 crore rupee kept in FD at 6% fixed interest rate would generate a fixed income of 6 lakh rupee. So that would be rupees 50,000 a month. Now in that case, a term plan with cover of 1 crore rupees is good enough. But here you need to consider two more factors. First is inflation. So let's say today your expenses are 50,000 a month. But due to rising inflation, in the next 5 to 10 years, your monthly expenses might touch 60,000 a month. In that case, you would need a cover of more than 1 crore, maybe 1.5 crore would be enough. Then second factor you need to consider is liabilities. If you have liabilities, then make sure that you add the amount in your term plan cover. For example, let's say you buy a home with a home loan of 50 lakh rupee. In that case, you should add this loan amount in your term plan cover so that if anything happens to you, your family can repay the home loan. Likewise, you need to add all the liabilities and accordingly calculate the term plan you need for your family. Another important question while shortlisting a term plan is till what duration you should take a term plan. To answer this question, first of all, you need to understand why you are even taking a term plan. Because today you are young and might not have a lot of money. So you want to ensure that in case of an unfortunate event, term plan will take care of your family. But by the time you reach 60 years of age, situation would change. You would probably have built a nice retirement corpus, your kids would have been settled, and your wife won't really need to depend upon the income from term plan premium. Basically, after 60 years of age, your family would not need a term plan. Hence, it makes sense to take a term plan at least till the age of 60. So that if anything happens before that, term plan will provide the financial cover to your family. And after 60, your family will have enough money. But many people get confused if they should take a term plan till 70 years of age or 80 years of age. Please keep in mind that term plan premium increases with increase in age duration. So you will end up paying more premium at the age of 65 as compared to age of 60. Especially after the age of 70 years, your term plan premium shoot up significantly as the average life expectancy in our country is 70 years. So it doesn't make sense to pay a very high premium by taking a cover beyond 70 years of age. So ideally you can have a term plan cover between the age of 60 to 70. Then third important question people ask is, I already have an employer provided term plan. Should I take a separate term plan? While employer provided term plan is a good benefit, there are a few issues with them. First is, since it is a group term plan for entire organization, it generally lacks the important features that you must have in your term plan. And second, when you switch your job, your existing term plan would be discontinued. So you need to ensure that your next employer provides you with the term plan. Moreover, if there's a gap in joining the next organization, you will have a risk of not having a term plan during that period. So if anything happens during that period, your family won't be covered with term plan. So I believe that it is always better to take a separate term plan. So in this video, we discussed what is zero cost term insurance and its key features and key parameters that you should keep in mind while selecting the best term plan for 2023. Since every person has a different requirement, so you need to analyze your requirement and then opt for the right term plan. If you need any help, then you can set up a call with Ditto team and they will guide you with the right term plan. Link is in the description. I hope you'll find this video useful. I'll see you in next video. Till then, take care.